Hi folks, welcome to this video that deals with accounts receivable and ratios. So in this question we have a company, Patwanic, and they've given us the beginning balance of their accounts receivable. Don't forget accounts receivable are those receivables with customers, so they're trade receivables, right? Opening balance for the year was $25,000. Net sales were $410,000, and of that some were cash and some were credit sales. Company, Patwanic, doesn't offer any cash discounts, and they had collections on accounts receivable during the year of $140,000. Your task here is to prepare journal entries for what happened during the year and to calculate the accounts receivable turnover ratio and find out how old the average receivable is. Then what we want you to do is to use the turnover ratio that you calculated here in Part B to analyze Patwanic Company's liquidity. The turnover ratio last year was 4.85 times. So don't forget, a turnover ratio for accounts receivable tells us how often those receivables are turning over during the year. So how frequently we're turning those receivables into cash. So let's look at the solution, first of all, to prepare the journal entries as we're asked to do here. So we know that we made sales revenue for the year of $410,000. We know they're not given any cash discounts, and we also had no mention of sales returns and allowances, so we assume that net sales are actually sales revenue. So we're going to credit that sales revenue. We're going to debit accounts receivable for $200,000, and then the difference should go to cash because only $200,000 of the sales revenue we booked was credit sales. Now we also know that during the year we collected $140,000 on those accounts receivable, so we're going to debit cash for the amount we collected and credit the accounts receivable for $140,000. So we've done Part A. Now we have to calculate the receivables turnover ratio. So if we now go to our formula, which we can get in our formula sheet in the chapter, we know that the receivables turnover ratio for accounts receivable, which are trade receivables, are going to be your net sales. Well, don't forget, if it's a receivables turnover, it has to be net credit sales because you only have accounts receivable if you have credit sales, right? So it's net credit sales divided by your average trade receivables. Again, because accounts receivable are trade receivables, we use the average trade receivables amount. Well, don't forget, your net credit sales for the period were $200,000. We know that from Part A of the question. And to calculate your average trade receivables, we're going to calculate the average receivables by finding out the beginning receivables, which we already knew in the question, opening $25,000, and our ending receivables. Add those two amounts together and divide by 2 to get an average. Well, to get the $85,000, how we do that is we'd look at our trade receivables at net, which includes our accounts receivable opening balance of $25,000. Anything during the year that we added to accounts receivable, which were $200,000, and our collections, which were $145,000. So we know at the end of the year we had total trade receivables of $85,000. So if we add together $25,000 plus $85,000 and divided by 2, we're going to get an average of what? $55,000. So $200,000 divided by $55,000 is going to give us 3.64 times a year. Or if we calculated how old the average receivable is, the age of a receivable is in days. So we know that if we collect on average 3.64 times a year, it's taking us about 100 days, or just over 3 months, to collect receivables. And how do we know? We take our 365 days and divide it by 3.64 times, which gives us the number of days that we calculate, right? In terms of the number of days it's taking us to collect receivables. So now, if you needed to comment, as we do here, to comment on the company's liquidity, we know last year receivables were turning over at 4.85. Well, if they're only turning over 3.64 times, that's less than 4.85 times. So in fact, we're collecting slower this year. We can actually figure that out as well if we wanted to convert that 4.85 times to days. What we would do is we would take the 3.65 divided by what we've got here, which should be 4.85. Okay, and that would give us 75 days approximately, right? So this year it's taking us 100 days to collect. Last period it was taking us 75 days. So we have a problem liquidity-wise, because if we're not collecting our receivables quickly, we're not able to pay down our accounts payable as quickly, right? So our liquidity problem is worsening. Now, if we want to improve our liquidity situation, what we might consider doing is offering early payment or cash discounts. Remember, our question did say specifically that Patwanic does not offer cash discounts. So we would probably want to recommend that if they want to get their receivables in quicker, customers might pay them quicker if we give them an incentive to do so, and perhaps consider implementing a cash discount program. So I hope this little video helps you to interpret and do this question.